Do you want to organize your finances, create wealth, and transform your wealth into a legacy? It's time to start today.
Welcome to Octane. My name's Andrew Wall. I'm the managing partner of CPA for IT.
And I'm Rachel Stedman, head of customer care.
Our new podcast designed to give your small business the fuel it needs to succeed. Hello, everybody. Welcome back to another episode of Octane. I'm back again with my amazing co-host, Rachel Stedman. And this week, we wanted to talk to you about paying yourself. Pretty important question, right, Rachel? I mean, it's probably the number one thing. It's
100%.
People want to know, right?
You know, a lot of clients, when they come in for consultation, they're like, okay, that's great. I have a company. I'm making money. How do I pay me? I got to live, right? How do I pay myself? How do I get money out of the company? How do I declare it? So I think that's definitely the number one thing that a lot of self-employed individuals want to know. What's the best options for them?
Absolutely. And one of the big things is, you know, a corporation, when you set up a corporation, it brings with it a lot of financial benefits, but most of those come from the ability to leave money inside the corporation as opposed to taking it out and paying the personal tax rate. If you take out every dollar that you've earned inside your corporation, you're in the same situation as if you were a sole proprietorship. So why have you paid all this money to incorporate and to file your tax returns every year to not really reap the benefits? So one of the limiting factors that we do have as accountants, and mind you, we do tend to have a few tricks up our sleeves here, so to speak, but we are limited by what's actually taking place. And if you have physically withdrawn the money out of your corporation, we are, in most circumstances, going to have to declare that as income to you, either as a salary or as a dividend. So I think when it comes to how do I pay myself, there's a couple of questions like, how do I physically withdraw the money? And then the physical withdrawals, how do I allocate those tax effectively? And so how you physically pay yourself is also a function of what tax strategy you use, dividend versus salary. And so maybe let's break down the difference between.
Actually, Andrew, before we even go down to the breaking up the difference, you know, one of the key things I like to focus with clients when, you know, it's your company, you want to take money out of the company. And, you know, sometimes clients ask, well, how much should I take? That's where we really kind of start, if you want to call it that, right? So, you know, it's like I tell them, well, I mean, I can't tell you how much to take. I don't know how much money you need.
I can, as little as possible.
As little as possible. But, you know, people got to live, right? So, you know, I tell clients, you really need to look at it from, you know, maybe it's your own personal budgeting and looking and see, well, how much money do I need? Because, you know, when you're an employee, whatever you make, you're subjected to paying personal taxes on that, right? Whether you need it, you don't need it. And you know, a lot of clients come in from a full-time to contract. They're like, oh, well, I was making $100,000 as an employee, so I want to make the same amount of money through my company. But it's like, okay, well, wait a minute. What do you need the money for? You know, because some clients want to pull out more because they want to invest it personally. And I'd say, well, why not leave it in, pay less tax and invest that in your company, right? So the starting point is kind of knowing, well, what money do you need? What's your household income? Do you have a partner? What's their income? How much, you know, you actually need to live on? And then we work from there. Okay, how we get you that money, how we declare that money. So that's definitely key for clients to kind of have a sense of what they need to live on.
Absolutely, that's the great starting point is like, what do you actually need for your day-to-day living expenses? And I joke when I say as little as possible, but I'm also not joking, because I think one of the things that you want to do is if you have a spouse who's working at a full-time job, their income is taxed. Like there's not much you can do other than contribute to the RSP. So after, you know, making the maximum or most beneficial RSP contribution for your spouse, you should be using that money for all your non-deductible lifestyle expenses so that you have a less requirement to pull out from your corporation. And so the number one strategy when it comes to paying yourself is the very first thing we want to do is pay for as much as we can through the corporation as a business deductible expense. And then if your lifestyle is such that you need money for things that we can't deduct, and at the end of the day, I'm not telling you to, like, you know, curtail your lifestyle, especially with you know, what's going on in the world right now? I'm like, spend your money, enjoy it. Like, I'm all for it, but let's do that as tax effectively as we possibly can, which means first and foremost, we want to be able to deduct everything. And we've had a whole session on what you can deduct in the past.
Yes.
So
Yes.
go check out that previous podcast episode.
Mhm.
But beyond that, you're going to have things that you're going to want to spend money on that we can't deduct. Like, for example, my RV that I bought that I, pretty hard
Not
for me
to
to claim
mention,
that as.
everyone's getting out of COVID. Everybody wants to travel. Everybody wants to go somewhere, right?
Yeah.
So unfortunately, that trip to the Caribbean is not exactly a business meeting, right?
Well,
So that
it
comes under
could be.
personal.
It could be, and that's a topic for another episode, because real estate investment is a great way to be able to travel the world and make business deductible.
Right.
But that real estate investment needs to be done through the corporation and
The company,
and we will talk about that down the road.
the little
for sure.
loopholes. We have the
Yeah.
little loopholes we can tell
Well,
clients.
There's always, like I said, there's always something up the sleeve. But getting back to where we were as far as paying yourself, if you've taken the money out, I'm going to have to declare it somehow, some way. So the first thing is, like, let's minimize how much you physically withdraw from the corporation, and what you need, take out, but take it out as you need it. As Rachel, you said earlier, sometimes people go, hey, I was making 100,000 before, so I'm just going to take out and deposit into a personal account,
Right.
100,000, because that's what I made before and I want to have the same. And that's not really a tax effective strategy, because, like, let's say you only needed 60,000 versus 60,000 to pay for your non-deductible expenses. You could have only taken out 60 and paid tax on 60, but because you've taken out 100, you're going to have to pay tax on 100, right? So the first step is, like you said, figuring out how much do you actually need, and then only taking out what you need. And sometimes figuring out what you actually need, we don't know until the end of the year once it's over. And that brings into account a couple of the strategies that we use here at CPA 4IT, which is, if we're going to pay you a salary, we often do that salary as an annual bonus as opposed to a monthly fixed amount. Now, the key with this is that you can't take out a fixed amount every single month and then get to the end of the year and be like, it was a bonus. Because CRA is going to go, no. You were paying yourself the same amount every single month. That is a salary, and I want you paying source deductions every single month on that salary.
Standardized when you do it that way. Yeah, like I tell clients, look, you need $5,000 now. That's great. 2 months from now, you need 10,000. A couple months, you need 3,000. Take as you need, right? As your expenses, require, that additional income.
Absolutely, and the key is, if you're taking out money as you need it in different amounts at different intervals and different periods, what we can do is we can call that a loan. Now, we have to charge interest, and there's paperwork that we got to do, which we will do for you to make sure it's done properly. But then we can call that a loan, so that you don't have to pay payroll deductions every single month, which gives us this ability to wait till the end of the year to see how much do you actually take out, so that we can keep your income as low as we possibly can.
Yes.
And then we get to the end of the year and we go, okay, you've taken out 60,000. Now, do we want that 60,000 to be income to you, Rachel, or are we going to do some income splitting with your parents, your children, your spouse? Are we going to do that as dividend, or are we going to do that as salary? And this is another.
Lots of options, right?
There's lots of options, and the first thing that no one understands is, no matter what strategy you use, the more people that you split it over, generally speaking, the lower your taxes are going to be. And that's because we have this tiered tax system where you have a basic exemption that everyone gets a certain amount for free, and then you pay a little bit more on anything above that, and then a little bit more on anything above that. But you're only paying the more on the parts above that. So if we can have 2 years of 50,000 as opposed to, or two people at 50,000 as opposed to one person at 100,000, because of the tax brackets, you'll pay more tax in total on the person on 100 than the two people at 50.
That is correct.
So now, of course, there are other issues to be concerned about reasonableness, because if we are doing salary is subject to a reasonableness test. So we have to say what you're paying your spouse or your children is reasonable for the work that they do. Now, with a spouse, being I don't know about most of the people listening, but it would be suicide for me to make financial decisions without involving my spouse or my partner. And so, having them as your trusted financial advisor, your partner, we can very reasonably justify salaries $30,000, $40,000 for their involvement in the business that way. Now,
But
when it
even
comes,
so, Andrew, didn't mean to interject, but what's also important when looking at doing tax planning and income splitting, we also need to factor in what that spouse's salary is if they're working outside of the home, right?
yeah,
So if you're adding an extra $40,000 and now it's putting them in a much higher tax bracket than even you are, then it's not really advantageous. So you really do need to factor what is their income outside of the home, what are you looking to take out, and then we look at doing that optimization from there.
yeah, and the optimization is making you guys as equal as we possibly can. I mean, if there's a little bit of a difference, but you're in the same tax bracket, it doesn't matter.
That's
but
okay.
the objective is keeping that as equal as we possibly can between each other and also between different years. So you're absolutely right. That's a key thing. And now the question is, let's assume that we figured out our the amount we want to declare, and we figured out who we can income split with. Now we have to figure out whether we want to do salary or dividend.
Dividends.
Yeah, and this is a question people ask all the time: what's better, salary versus dividend? And prior to the Liberals making changes on us, there was some very, very great advantages to dividends, which were we could basically give whatever dividend we wanted without having to have any justifyment, without having to justify it or have any involvement in the business. That changed a couple of years ago with these new rules called TOSI, which stands for Tax on Split Income. And the long and short of these very complicated rules is they made it tax ineffective to do income splitting through the use of dividends. Now, it didn't mean you can't do dividends. It just means that if you do dividends, they're going to be taxed at effectively the highest possible tax rate, which makes it completely ineffective and negates the purpose. Now, there are some exceptions to TOSI. Most notably, if you're over 65, you can do some income splitting with your spouse. There's also other exceptions when the children or other family members are actively involved in the business, and there are specific requirements that need to be met on that. But again, this is effectively coming back to a form of reasonableness, right? So there's no real benefit to dividends from that standpoint of like being able to give any amount we want, which there used to be. Okay, that strategy is now gone. Where dividends do have still a very big difference between salary is in how they are taxed. Now, the total tax ends up being very similar because there's something called the theory of integration. And the theory of integration is intended to make it so that there is absolutely no difference between taking a salary or taking a dividend.
Versus a dividend, yeah.
If you're the owner of the company. And people have done all sorts of calculations to see if there really is a difference. And I can tell you there's no material.
Very slim, yeah.
Yeah. So if you're saying there's no difference in tax, what are the differences? And the differences is, number one, how they're taxed, because a salary is a deductible expense to the corporation. So the corporation pays no tax on it at all, because you have your revenue minus your expenses equals your taxable income. And if your salary is a deduction, the corporation has paid no tax on that. Because of that, you as an individual will pay the full personal tax rate. You get no
based
credits.
on the brackets, yeah.
Yeah, based on your marginal tax bracket. You will also be required to pay into CPP. You will have the option, if you are an owner or related to the owner, you'll have the option to pay into EI. We don't recommend you do, but you would have that option. And you would also build RSP contribution room. So right now it's about 18% up to a maximum amount of your income that you've earned through the year. That's how much eligibility or how much room you would be able to contribute. And RSPs, again, we'll do a whole nother topic on those. But they're, RSPs and CPP, we think is a good retirement strategy.
Long-term planning, yeah, it's definitely beneficial. A lot of times, when clients are looking at employment versus dividends, there's a difference between short-term benefits versus long-term benefits, right? And being able to contribute to your CPP, having RSP room, putting into your RSP, all of these things are, really making sure that you just don't have just one nest egg down the road when you're looking for retirement, right?
Absolutely, but the reality is, it is a cash flow difference because you're paying into CPP, right? So if you go with a dividend where there's no CPP, you're not outlaying that right now. So
not
that's
to mention as well, the CPP, you got to pay the employer and the employee portions, right? So,
now you get
employee.
in theory, you get 100% of that back plus some growth down the road, but it's down the road. And so if sometimes cash flow is an issue and you're looking at, I just don't have it to pay, so how can I just limit the overall amount of outflow, as well as mitigate when I have to pay my taxes? Because that's another big difference with a salary versus a dividend, is with a dividend, the shareholder is responsible for paying the taxes, and they do that when they file their personal tax return. Whereas a salary, the employer is responsible for doing a withholding and remitting that withholding to CRA. And the deadline is, it's very complicated. Again, we have entire sessions dedicated.
We touched up on that a while ago, so yeah.
Yeah. So go back, watch our episode on deadlines. But it gets complicated, but it's generally speaking, it's earlier than a dividend. So you're going to get a little bit extra time to pay that dividend. However, the dividend, there's certain tax deductions that you can't apply against dividend income, most notably like childcare expenses, right? So you want to be aware of those fundamental differences, and also understand that because a dividend comes off the balance sheet out of your retained earnings, it's not a deduction, it's not an expense to the corporation, which means you're taking this salary out of monies that the corporation has already paid tax on. So because of that, you'll get a tax credit on your personal side intended to offset the taxes that you paid over in the book.
I think you said salary, but it's actually dividend.
Dividend,
yeah.
sorry. Yeah, thank you for clarifying. That's really important. And so the theory of integration, like I said, is trying to make these things equal. Now, of course, CRA, to make sure they keep accountants employed, have made this very complicated with a dividend gross up amount and then a dividend tax credit, and then also talking about eligible dividends, non-eligible dividends, refundable dividend tax credits, to make the whole thing really complicated. But the long and short, I'll make it real simple for you. They're going to give you credit on your personal tax return for whatever the corporation has paid. If the corporation paid tax at the lower tax rate because they're a small business, it's a non-eligible dividend, so you get a smaller tax credit. If it's a large corporation who paid tax at the higher tax rate, it's an eligible dividend, you get a smaller tax credit. All of this meant to, like I said, make it the same. So the question then would be, well, in which situations might a dividend make sense over a salary? And tax planning is an art, not a science. So there's no necessarily right or wrong way, unless someone has a crystal ball and knows definitively what's going to happen in the future. Because
everybody's situation is different, right? There's so many factors that are come into play to really be able to determine. Because even sometimes, clients come and ask me straight up, should I pay myself employment dividends? And I'm like, ooh, that's a loaded question. There's so much that needs to go into factoring what is the best strategy for you. And that's why tax planning really is, it's definitely not a, one answer kind of response to get that information.
Absolutely. And so without having that crystal ball, without talking about the individual situation, it really is hard to say. Now, there are a couple of general rules that are good guiding principles, but it doesn't make that applicable in your situation. So the general rule that we use for our tax planning here is that, generally speaking, we want to pay salary in what we call your income earning year. So if you're earning income and you've got an active contract and you're generating revenue inside your corporation and you're building wealth, then we would make sense to take that money out of your corporation, reduce the taxable income of the corporation, pay salary, get RSP room, contribute to your CPP, build up for that retirement strategy. Even if you're earning, recoverable dividend tax on hand that's building up, that's a good strategy. And then once you move into a retirement phase, so you're now into a holding company and you build up all these assets inside your corporation, and the corporation will be a living entity that will continue beyond your income earning years, but you're not actively contracting or actively generating income in this corporation. So if we were to deduct a salary, we'd be deducting an expense against zero income, which would mean that we would have a loss. Now, there are a couple of situations where having a loss would make sense, but generally speaking, it's not a good strategy. So in that phase, we switch over to a dividend strategy in your retirement years or your non-income earning years. and we start pulling money out of the corporation. And because it's coming out as a dividend and the corporation paid tax on that back when you earn the income, you can now pull that out in your retirement years at a lower tax rate. So the whole idea here is in retirement, we want you down in lower tax brackets. It's costing you less tax. We're also want to make sure we're not, getting clawbacks on CPP and OAS. So we want to have lower income and access to like higher, so you've got a lower total income, but you're getting more of that income out because it's taxed more effectively, right? And this is the general strategy. Now, of course, there's exceptions to this, and lots of reasons why we would break from that general rule. But for those people who want to know salary or dividend, that's the generic answer I can give you, with the caveat of you really do need to look and talk with your accountant, and also do your best to predict what you think the future will hold. We know no one has a crystal ball.
Crystal ball, yeah.
But being proactive and doing our best to plan for the future is how we get the most effective tax planning strategies out. Because the fundamental principle that we're trying to do is smooth this income, not only between individuals, but over longer periods of time. Anytime that we have spikes and valleys, you're going up one year and down the next, up one year and down the next, you'll end up paying higher overall tax.
That is true. One of the things to that, Andrew, even when we have individuals that are newly incorporated, now sometimes, we have clients who incorporate with us, sometimes people incorporate on their own, or they go to a lawyer, et cetera. When you're looking at setting up a company from a registration purpose, it's set up accurately. But what's important in terms of how you structure your company is what you structure within your initial minutes, right? And that's very key, because a lot of clients coming in, the first thing I want to see, let me see your initial minutes. Let me look at your share certificates, your strategy there, because that actually will impact your options for tax plan and employment income versus dividend income.
Absolutely.
Right?
I can't do dividends if you don't have shares.
Exactly. Or let's say, sometimes clients, they say, well, it's me and my wife, everything is 50-50. And I say, that is so romantic. No, right? Because a dividend income might work for you, but not for your spouse, depending on the situation. So how your company is structured is really going to impact your tax planning strategy long-term, right? If you have other shares that you can issue to family members down the road. So that is also very key, and one of the first things we like to look at to see, we want to make sure it's structured so you have those options. So again, not having those crystal ball, right? But at least it gives you options for down the road. So that is really key.
And that's basically so we can stuff more tricks up that sleeve down the road. And we want to have as many options as we can. That's such a good point, because all too often we'll have people who run off, do their incorporation themselves, thinking they're saving a few bucks, bring it out to us, and we're like, oh, well, we got to change all that. And by the way, it's going to cost us as much to change it.
It does.
We would have charged you to do it.
Here's the thing, though, even when we're looking from a cost perspective, right, to make the changes, I tell clients, look, you got to think of it. It's cost versus benefit, right? If the benefit outweighs the cost, I get it. It's a little bit more because you didn't know, you didn't set it up right. But if there's a long-term benefit to that, you really want to take advantage of that.
Absolutely. And I think, one of the things to understand is that while you can change the structure of a corporation down the road, there are a whole bunch of issues once you have the money. So if you've built up a whole bunch of money and you have structure a certain way and you want to change that structure, even if you change that structure, basically, the long and short of it, CRA is going to say, no, that structure pre-existed, and that equity that you had before belongs to the shareholders who existed then. And if you don't grow that equity and you try to do a distribution down the line to a new shareholder that you've added, it'll be a deemed distribution. It'll be as if it went to the original shareholder. So you're not getting any of the benefits of those changes. So you want to make sure that you're structuring your corporation before you're building wealth inside of it.
That is true. That is very true. And another thing too, Andrew, is that even, whenever we're looking at clients when they have their spouse or they have children over 18, I advise that you add these family members under the business. Now, most
Yeah.
people think, well, once I add them as a shareholder, that means I'm obligated to issue them dividend income. That's not the case at all. It really isn't, right?
Absolutely.
And although, yes, there are some changes, with TOSI in regards to, income splitting, but that can also change down the road, right? With different government, things
Exactly.
can change. So you still want to have a really good structure. Now, the other thing that's very key, even when you're looking to add other individuals, sometimes I have clients say, well, you know what? I don't need to give any money to my spouse now, so I don't want to add her as a shareholder, okay?
Right.
Which is fine. But what happens down the road is if you say, oh, wait a minute, Rachel, 2 years ago, you told me about adding my spouse. I want to add her now and give her dividend income. It's not so easy, because here's the thing, you cannot give dividend income to your spouse based on retained earnings accumulated when your spouse was not even a shareholder, right?
Yeah.
So it's only any new retained earnings after your spouse became a shareholder. So that's why it's so important to add your family members on from the onset. So as the business is growing in terms of retained earnings, your spouse is eligible, or your family, your children over 18 of the family members become eligible to receive dividend income for any retained earnings accumulated while they were a shareholder, right? So again, these different strategies are really so important.
Absolutely. And like you said, it's really good point is like, we had changes with tax on split income that took away some of the benefits of the strategy, but we never know when that's going to change. So we always structure our corporations so that we have, like I said, I'll keep using this sleeve as an analogy. So we have as much opportunity to stuff down that sleeve so that we have the opportunity down the road to pull that out. And I think that is a really key thing when it comes to that long-term strategy is, we want to help you organize your finances, create wealth, and transform wealth into a legacy. And so that involves the whole family and making sure we do everything we can with a holistic, long-term plan and not focusing on only today. But on that note, I think that brings us to probably a wrap for today. I do want to encourage everyone and let you guys know we have new episodes dropping every Thursday. So, check us out. Go back to some of the past episodes. There's some great content in there. And we're committed to coming back every week with fresh new content to help you organize your finances, create wealth, and transform wealth into a legacy. So Rachel, thanks again for joining me.
Thank you, guys. See you next week.